I alluded to before the break, banking regulator APRA, this is the Prudential Authority, has cracked down on risky home loans. And this will be about your ability to service a loan. It will make a big difference to who's getting money in the future. And the move comes against the backdrop, of course, of house prices rising nationally at their fastest pace in more than 30 years. Let's bring in my panel, economics panel, business commentator Terry McCrann and founder of Switzer.com.au, Peter Switzer. Terry, let's start with you. APRA says these changes are necessary. It feels like it's a hot market and they're stepping in.
I'd give it a muted plus, Peter. I think it will take some of the heat out of the property market, and quite reasonably. It will require the banks to test the ability of anybody they lend money to accommodate higher interest rates, because the interest rates that they can borrow at right now are clearly completely unsustainable over any length of time, and certainly over the length of a home loan. But the increase is fairly marginal. I mean, we're talking about the bank saying, APRA saying, borrower has to be able to ensure they can pay the interest rate if it goes to about 5%, as opposed to 4.5%, given that they can borrow around 2% now for owner-occupied loans. So I don't see it having a major impact, but I guess it will have some positive impact in taking some of the heat out of the market. But the downside, of course, is that it will hurt some borrowers, that they'll make that just that harder to get back into the property market, or get into the property market in the first place.
Yeah, Peter, they're not ruling out further action. You know, the argument being, spoken about by economists, this is sort of like pressing the brakes lightly. They say they could do more. What more could they do?
Well, Brian Johnson, who's a pretty well-known banking commentator, he thinks that the buffer could be raised probably by 5%. He's sort of saying that the 5% that Terry mentioned could go to 7% before this interest rate cycle is over. It will depend on the effect of this first rise. And, as Terry implies, it might not be all that much. I do think what we're going to see in the November and December months, a greater supply of property on the market that will help slow down the price rises. But I can't see price rises going from, the double digits we've been seeing, 20% in Sydney over the last year, to anything really small. It might be, say, a rise of 7 or 8% next year. And that's why the banks will probably be forced to make it harder for people to get loans as 2022 becomes a stronger year for the economy.